if somebody just looks at rates, they think, okay, rates are rates. They're all controlled by the same thing. Like so many people, like you talked about, they said, hey, they just know in their heart when the Fed announces it's going to cause a rate drop, but it didn't.
Right.
Why are the home equity lines of credit and the fixed HE loans, why have those dropped, but the others have not? Are they two different sources of determining what rates they are?
Yeah, absolutely. The thing to keep in mind is that first mortgages, almost all of the most common programs that are utilized, that's conforming. Well, conforming again, for our viewers, that means conforming to the maximum loan limits to the two government-sponsored entities, Fannie Mae and Freddie Mac. So conforming loans, FHA, VA, USDA, all of those loan types, and even actually non-conforming jumbo loans, all of those loan types generally are serving as collateral for securities, for bonds, sometimes called on the conventional side mortgage-backed securities. For FHA, VA, USDA, they call them Ginnie Mae's, Government National Mortgage Association, which buys government loans, government insured or guaranteed loans from lenders and package those to collateralize bonds that are sold in the financial markets. So first mortgages generally are not affected directly, as I said, directly at all by the Fed. It's all about the bond market. So I always tell people, if you're looking for a first mortgage, stop focusing on the Fed. Focus on the bond market, specifically the 10-year Treasury bond. That is absolutely your best barometer to follow, to track. And you can do this day to day, like I do, day to day, all day. And you can, as that yield goes up and down, the pricing of these first mortgages are being affected by that in real time. Now, the equity loans, a whole different ballgame. Equity loans actually with a lot of banks are considered consumer loans, even though they are secured, in particular HELOCs, even though they're secured by your home, by real estate. But how they're priced is entirely different. It's not as much about bonds at all. It's more about cost of funds. And of course, that's where the Fed funds enters the picture, because Fed funds is a direct index for a bank's cost of funds. That's why the prime rate, the commercial bank prime rate, is directly correlated to the Fed funds rate. And that's why, if you've got a HELOC, and even those fixed rate seconds are going to be more directly correlated to and more directly affected by the Fed's action. And of course, last week it was half a percent down. And that's why on the equity loan side, we're seeing better rates, whereas on the first mortgage side, they're higher.